important reasons, really. And that is, our clients were sitting here watching the crazy Japanese. They have very much their own economy, their own culture, and they were able to say, wow, that's crazy behavior. And they believed us that sooner or later things would work out badly. And they were not willing to fire us. But when it came here, in the tech bubble, most of our committees had a majority of people who believed, more or less, that it was some sort of golden new era, which is what Greenspan was saying, that the internet would drive away the dark clouds of ignorance and other such nonsense.
And how did you know different?
Why is that nonsense?
We didn't know different. We just looked at the numbers and said, every bubble has broken. This is the biggest in history. It will break. Japan was even bigger. It will break. And they all
have some magic formula to define a bubble before we see it?
Yeah, a bubble, we had to make a definition long ago, and we decided to have a statistical definition of the kind that would occur every 44 years in a random world. It isn't a random world, but it's closer than you think. The kind of event that would occur randomly every 44 years occurs in the real world every 30 years. It's much closer than we expected. But people are getting used to black swans, but they aren't as common.
So then comes the subprime crisis. Did you see that?
Yes. Oh, yeah. But that was
easy?
That was absolutely
easy. That's what he was talking about.
We were lucky.
So, would you know what it did to the global economy?
Absolutely. And we said it
was
by
by
97,
80 something.
We can't do more. I'll tell you what.
You're the only smart man in...
No, not the only one. We
literally... You're the only smart man?
We talked to about a couple of dozen people. Newsletter writers, economists, stock advisors, about a couple of dozen. They all saw it coming. It was not at all difficult. We're lucky in that we focus on bubbles. The U.S. housing bubble, done statistically, was a much more impressive bubble than the tech bubble. Because the U.S. housing market, unlike the stock market, had been very stable going back into the midst of time. It would bubble in Chicago or Florida, but it would bust in California. So it was perfect until Greenspan. And then a great surge of debt pushes up the price of houses. And on our data, it was the kind that would occur randomly every 10,000 years. By the way, Bernanke did not see this. He said, oh, the U.S. housing market merely reflects a strong U.S. economy.
John Paulson saw this and became a multi-billionaire. Did you see it in the same way, and did you act in the same way?
My job, just to focus on what I do, is to inform our clients and write a quarterly letter.
But don't you have money? Don't you have money under management?
Well, our team of 550 people run 100 different funds, and
with over $100 billion.
And I don't hesitate to nag them, but I don't have line responsibility. I delivered my.
But are they listening to Jeremy at the time?
Mostly they do, but you can't run a big firm on imperial fiat. You have to allow a small group of people with self-confidence to make their own decisions. But I can tell you what I said. I said, I have a problem, dear reader, in that I've been bearish for a long time. The market, in my opinion, was basically overpriced for 20 years. So how am I going to get you to take this seriously? Because this is the real McCoy. And I have thought about it for a couple of weeks, and this is it. And this is July '07. I believe at least one major bank will fail. Broadly defined, meaning the definition of the bank.
Hello, Bear Stearns.
Hello, Bear Stearns, Lehman, AIG, etc., etc. Plus a couple that would have failed but were taken out. Plus a couple more very, very big banks like Citi that would have failed unless we, the taxpayer, had come to their rescue.
Was that the good thing to do? Come to their rescue?
You had to keep a few banks. Morgan and Wells, maybe, in business. We should have
would have let Citi...
I would have let a couple of big ones
go. Would you have let Citi go?
Yeah, I think so.
You really would?
Yeah, it would have sent a shockwave through the system.
No, but well, look what happened when Lehman went down. They let it go. Look what happened.
I know. Once you'd let Lehman go, I would have let Citi go as well, in order to make the point that we were not going to stand behind every enterprise that made ludicrous bets and then got bailed out by the taxpayer. Then I would, of course, you have to draw the line. You can't afford to run on the bank. Any solvent bank, as that famous American Christmas time movie shows, if everyone comes to withdraw their money,
wonderful, yeah,
they go bust temporarily because it's all tied up in long-term mortgages. And that applies to the banking system. It is universally agreed that the role of a central bank is to make sure that a run on the bank doesn't happen. But it is not agreed that they should support a bank that is insolvent. Citi was insolvent. A lot of banks were insolvent. In other words, if you just marked their assets to market, they were underwater, they had no assets, they had made mistakes, they'd called the market wrong, they should pay the price.
Now, there is this circumstance. Standard & Poor's, look, and Dow Jones are approaching record levels. Right? Merger activity way up. Warren Buffett and some Brazilian investors just bought Heinz. Okay? Everybody thinks things are getting better. You seem to say, yes, short term. Long term, no, no, no. Correct me.
Our long-term argument has nothing to do with the market.
Right. It has to
you can do perfectly well in a portfolio in an economy that's growing very little.
Right, okay.
It has to do with profitability. I have no reason to think good companies will not be profitable. So this is not about the stock market. That's about the long-term economy,
So
which
what
is
is
going
it
to grow more slowly. So you can make good money in the long term in cheap stocks. What it's about is value. If you have a market that becomes overpriced, you will make a return too little given the risk you take. The U.S. market is not too bad for the great franchise companies. The great Coca-Colas, they're a little bit expensive. But the balance of the market is very expensive. And it's very expensive because we assume profit margins will go back to normal and prices in every way will go back to normal, back to the trend line. And if we do that, we get miserable zero returns from the rest of the market in the U.S. Now, you get better returns overseas. You get almost reasonable returns from emerging market equities. So it's not a terrible situation. 2007 was overpriced across the kitchen sink, everything in the world. This is merely
but
overpriced.
amazing so few people saw it.
Well, that isn't true, by the way, and I have a story up my sleeve here. And that in the great...
You've been waiting to pull.
In the great bubble of 2000, there weren't many people who were willing to debate the bulls. And so they dragged me out over and over again. And I thought, well, if we're going to go down with the ship, we might as well go down with the flag flying. So I went out and I debated them. And my price for giving a talk amongst professionals, say the annual bash of the financial analysts, 1,200 people in Los Angeles, was to say, how many of you are full-time stock professionals? And 300 people put their hands up. And I say, right, I have just two questions. If the price earnings, the measure of how expensive the market is, it's currently 32. If it goes down to 17, which is trend line, will it guarantee a major bear market? Every single one of the 300 agrees. And by the end, I had 1,200 votes of full-time professionals. So they all agreed, every single one of the 1,200, if it went down to 17 times earnings, it guarantees a major bear market if it happens within a 10-year window. So the jackpot question is, and how many of you think it will? And it was so shocking to me, I had to rephrase the question 3 times before I would accept it.
Because nobody raised their hand?
Only 7 people thought it would not go down.
Right.
So 99% of the engine room at all the great firms knew very well that the market was vulnerable, would go down, and would guarantee a major bear market. But the spokespeople who employed those guys, the spokespeople for the firms, were on the podium with me saying, oh, we'll muddle through quite nicely. I won't mention their names on the air. But they are very famous people, and they said, oh, don't get hysterical, we'll muddle through, okay.
Jeremy is always putting down things.
Absolutely. But the people who were doing the dirty work knew better. They agreed with me. And the reason is simple. Being bullish sells. You will not easily hear honest advice when it is bearish.
Okay, so just in case somebody tuned into this late, so where are you today? To repeat what you said at the beginning.
We're slightly underweight global equities, heavily underweight in the U.S., outside the quarter of the market that are the great Coca-Cola franchise companies. And I'm not touting Coca-Cola. I'm just using them as a generic.
Yeah.
So it's not terrible outlier situation like Japan that we described, or so on.